Bitcoin is often called digital gold, but over the past decade it has revealed itself to be something far more precise. One of the most sensitive real-time barometers of global liquidity and central bank interest rate policy ever created. In recent cycles, Bitcoin has repeatedly shown its ability to rebound sharply from local lows, often staging significant recoveries within just a few weeks. And those rapid rebounds never happen in isolation. They almost always mirror shifts in liquidity conditions and changing expectations around central bank policy. It is the direct reflection of easing short-term dollar liquidity stress and growing market conviction that the Federal Reserve is about to pivot toward a more accommodative stance. Let us examine the evidence that has held true across multiple market cycles. First, the long-term data is unequivocal. When researchers measure Bitcoin's price against the broadest gauge of global liquidity, Global M2, which aggregates US dollar, euro, yen, and other major currency money supply components, the correlation coefficient over rolling multi-year windows is an astonishing 0.94. To put that in perspective, very few asset pairs in traditional finance exhibit a relationship that's strong for that long. What does this mean in practice? When central banks expand liquidity, whether through quantitative easing, pandemic-era stimulus, or simple reserve creation, capital flows into higher beta, non-yielding assets. Bitcoin, with its fixed supply and zero cash flow yield, sits at the very top of that risk curve. The result: explosive upside. During the most aggressive liquidity waves, such as 2020 to 2021, Bitcoin delivered annualized returns exceeding 200% at its peak phases. The opposite is equally dramatic. In 2022, as the Federal Reserve executed the fastest tightening cycle in 4 decades and began quantitative tightening, actively shrinking its balance sheet, Bitcoin collapsed more than 70% from its then all-time high of approximately $69,000 in November 2021 to lows near $15,800 by December 2022. Liquidity withdrawal was the primary driver, not the Terra, Luna collapse or FTX, which were merely accelerants. Today we are witnessing the mirror image of 2022. The U.S. Treasury General Account has ballooned toward $1 trillion, temporarily absorbing hundreds of billions of dollars of bank reserves and creating short-term dollar scarcity. Money market indicators such as the SOFR Fed funds spread widening to +30 basis points and the reappearance of overnight repo operations confirm the squeeze. Yet market expectations frequently tilt toward upcoming rate cuts, with many analysts anticipating further easing whenever central banks hint at a more accommodative policy path. Lower interest rates achieve two powerful effects simultaneously. They reduce the opportunity cost of holding a non-yielding asset like Bitcoin. They also tend to weaken the US dollar index, and since 2014, every 10% drop in the DXY has typically been followed by roughly a 35% surge in Bitcoin over the next 6 to 12 months. Institutional adoption is reinforcing this macro sensitivity. Spot Bitcoin ETFs now see consistent unhedged inflows, corporate treasuries continue to accumulate, and the 4-year halving cycle, while important, is increasingly overlaid by the dominant global liquidity narrative. For investors and allocators, the implication is clear. Bitcoin should no longer be analyzed in isolation through on-chain metrics alone. It has evolved into one of the purest leveraged expressions of central bank policy and global money supply dynamics available in public markets. Do you think the coming rate cuts and a potential return to quantitative easing will push Bitcoin to new all-time highs? Share your thoughts in the comments. If this type of macro-driven analysis helps you navigate the markets, please give the video a like, consider subscribing, and hit the bell so you never miss an update. Thank you for watching, and I'll see you in the next one.